delighted to speak with everyone in this format again. A little strange to be doing it by video, but this is the world in which we live. What we're going to do today, because we ran out of time quite badly the last time I did a shares event, we have elongated this a little bit. And so I'm going to speak for a little while, especially for the sake of those of you who might not be all that familiar with Burford. But then we're going to have a longer than normal period for questions. So this entire event will go for about 45 minutes instead of 30 minutes. And I'm going to use a little bit of it now to walk through a few slides, but we're going to use the bulk of the time for Q&A since there were a very significant number of questions the last time I was here. And we want to get to as many of those as we can. So let's first of all, for those of you unfamiliar with Burford, why don't we start on slide 3, and let me give you a little bit of an overview. So Burford is a litigation finance firm. We're the market leader globally in litigation finance and legal finance. What does that mean? Legal finance is simply the business of treating pending claims, whether those claims are court claims or arbitrations or other commercial disputes, and we only do commercial disputes. This isn't a consumer business. Treating those claims as financeable assets. There are companies the world over that are frustrated with the cost and time that it takes to pursue claims, even though they have strong meritorious claims that they want to be pursuing. They find it difficult to get capital allocated to those claims inside their businesses. I used to be the global general counsel of Time Warner, the media group. Time Warner had lots of money, but the CFO never wanted to give me any of it, and certainly didn't want to give it to me so that I could go and spend it on a whole bunch of expensive lawyers to pursue some claim that might give Time Warner some benefit far off in the future. Instead, which for reasons that I always thought were strange, Time Warner wanted to run its core business, put its money behind movies and television shows. And so you have a world, especially as the volume of claims has increased out there and the cost of claims have increased out there, you have a world where it is increasingly difficult for companies to find a cost-effective way to pursue them. In fact, about 3/4 of all businesses say that they have failed to pursue meritorious claims because they haven't been able to find the financing necessary internally or externally to do so. And so what Burford does is it steps in and it looks at the expected future value of a claim, and it provides financing against that expected future value. That financing is sometimes used for the payment of legal fees and expenses, which relieves the P&L pressure that businesses face. And it's sometimes used actually as a balance sheet matter to provide some liquidity and some operating capital to businesses that would like to take advantage of the future value of their claims. And so that's what we do in a nutshell, and I'll come on to a little bit more detail of it as we walk through some of these slides. When you look at this slide here, and these are the slides from our first half results, which we released a little while ago, we had a terrific first half. And I'm really pleased with where the company sits today. We saw a significant volume of cash inflows and realizations during the first half of the year. And on top of that, the other thing that happened to us recently is that we were approved for a dual listing on the New York Stock Exchange in addition to maintaining our listing here in London. That's a very significant feather in our cap. We're the only firm in the world, the only litigation finance firm in the world to have that kind of accolade. And it obviously meant that we had gone through a very extensive process of regulatory scrutiny by the Securities and Exchange Commission in the US, which is widely regarded as one of the toughest regulators in the world. So our shares actually begin trading on the New York Stock Exchange on this coming Monday, the 19th of October. And we're excited about the possibility of accessing an incremental pool of liquidity. We've been wonderfully served by the London market for the last 11 years, and we certainly absolutely intend to continue that. But what we found is that American investors are quite familiar with what we do, And many of them have not been able to access Burford shares because they haven't been able to buy stocks that are not traded on a US exchange. And so by adding that US listing, we're hopeful that we continue to raise the profile of the business and attract some incremental liquidity into the shares, so that we can continue the trajectory you've seen just recently. On this page here, I'm not going to dwell on a lot of numbers at this point, but you can see that that our returns actually ticked up even a little bit. Looking at the lower right-hand corner, we've had pretty consistent IRRs over time, and our simple returns, our returns on invested capital, actually ticked up a little bit because of some activity in the first half of the year. Those returns now are over an 11-year track record on more than $1.6 billion of cash brought back in the business. These are not accounting numbers. There is no accounting valuation here. These are concluded investments that have returned cash to the business. And so those return numbers that you're seeing there are cash on cash investments. So we're quite pleased with the steadiness of returns over a very large pool of deployments that we've been able to generate. And as you can see from the other data points on this page, the first half of the year was very strong for us, as I said earlier, with a number of realizations. If we could go to the next slide. The thing that is driving these realizations, if you look in the top right corner of this, is the fact that the large investment vintages that we made in 2016 through 2019 have begun to perform. Litigation obviously is not the world's fastest thing, nor is it particularly predictable. You know that when you start a case, it's going to wend its way through the court process. You know that's going to take several years in most instances, but it will ultimately come to an end. It will either resolve itself by settlement or it'll be adjudicated. And so what you're seeing now is the realizations and the performance that is starting to come out of those vintages. And it's obviously not surprising that it's coming more from the older than the newer vintages. But that, I think, also gives you a sense that if performance continues to be as it was, there's more to come from these vintages, again at an unpredictable rate of speed, which is a huge benefit. Not only does it mean that our cash flows are entirely uncorrelated with the market and with economic conditions, but this is why Burford is able to generate the returns that it does, because these are complex assets that are difficult to predict. If these assets were all predictable as to outcome and duration, you wouldn't need Burford. A bank could do this, and the returns would be much lower. For those of you who have followed Burford for a time, you know, and I'm talking now about the bottom right-hand quadrant of this graph, you know that we have a particularly large matter that relates to YPF. Sometimes it's called the Peterson matter. And in the first half of 2019, a fair bit of our income came from that matter because there was a significant positive development in the case. And we also engaged in a substantial secondary market transaction with a portion of our interest. Peterson has, by the way, now over time already generated more than a 10 times return on our cash. But the important point here is that none of our 2020 income came from Peterson. So it all came from other cases in the portfolio. So Peterson is an important part of our book. And we're excited about the case, but it certainly the results certainly underline the point that Burford is by no means a one-trick pony. Let's turn the page if we could. What you saw in the first half as well, looking at the right-hand side of this slide, is not only did we have overall generally strong realizations, but some of those realizations came from a particularly strong performance of a large group of related cases. We had invested in these cases $144 million group-wide. That includes our investment funds, $94 million from the balance sheet. And we produced very nice returns on those. The $144 million turned into $423 million in realizations, $279 million in profit. And you can see the nice ROIC and IRR numbers there under the graphs. This is something that is increasingly part of our business. If you think about litigation, it really breaks down into two big buckets. And again, to emphasize, I'm really just talking here about large dollar corporate litigation. We don't do consumer, we don't even do middle market litigation. So the first kind is companies suing each other. You know, company A will have a dispute with company B and they'll bring a piece of litigation about it. It'll be a contract claim or something else, and that case will either settle or get adjudicated by a court, but it's just between those two companies and nothing else is really involved with it. The other big bucket is where there's something that spans many companies. An example of this is when you've got price fixing or cartelization in an industry. As you've seen, for example, in Europe among diesel truck manufacturers and in various industries in the United States. And there what you have is a whole collection of claims because you have a whole lot of companies that were buyers of those products and were overcharged for them illegally. And you've got a whole lot of defendants who were the manufacturers or the suppliers of those products. And there's not one common claim. You know, company A may have bought from, company A may have sold to companies B, C, and D on the one hand, and so there will be claims there. Company company Z or Z may have sold to companies, you know, W, X, Y. And so there will be a different batch of claims there, and they may overlap with each other as well. And so what we increasingly do in large dollar cases like that is we will provide financing, we will provide capital to a number of the injured parties there who have related cases. And this is a considerable efficiency for us because once we've done the work and decided that we like the proposition, being able to replicate those investments is efficient for us, and as you can see, can also generate very, very desirable returns. And let's turn the page again, please. So this is just a repetition of the returns that we saw on the front page, but it also adds in duration on the right-hand side. And what you can see there is that even though there is an absence of predictability and there is lots of deviation from the mean, you still see us having fairly consistent weighted average lives for these investments. And let's turn the page again, please. Now, the next two slides we're going to look at really come as a pair, and they're really important to understanding the business. So this slide graphs out for you the way that the business actually operates. We make commitments, and I'm starting from the left-hand side. We make commitments in the first instance. So we say to people, yes, we'll provide capital against the future value of your case in a certain amount. That commitment either will go out the door all at once, especially in the case of a monetization, or it will go out the door over time as the case makes its way through the litigation process. And we call those deployments once we've put them out the door. So we've got a number of deployments there. Most, but not all of our commitments get deployed. And the reason that number isn't equal is because some commitments don't ever get spent. The case settles, or for some other reason, they're not drawn before the end of the investment. So then there are really three possible outcomes of any piece of litigation. You can win, you can lose, or you can settle. And as you can see from these numbers here, settlement represents a majority of the litigation outcomes in our portfolio, and that's also true in the litigation system itself. A majority of litigation matters settle whether or not Burford is involved in them. And the settlements, as you would expect, happen somewhat faster because you don't have to go to trial and you don't have an appeal and so on. So we have a weighted average life of settlement cases of about 1.5 years. And as you can see in the black box, they produce quite desirable returns. Excuse me. If cases don't settle, they go to adjudication, to trial, to an arbitration hearing, or some other form of outcome producing result. And then you're taking risk. When you settle, there's no litigation risk. You're taking litigation risk off the table, which is why the returns are lower in them, because you inevitably have to take a discount to settle your case. If you don't settle and you go on to trial, then you have litigation risk and you lose. you can lose, and we certainly do lose some of the cases that we take. 10% of the time we lose cases. But you also win much more than you lose in our business. So we win 75% of the cases that go to adjudication. And you can see that when we do win cases, we get very outsized returns that are about 5 times higher than if you settle. And the reason for that, of course, is both more of our capital is being used for longer, so our returns are higher on our capital, and there's no settlement discount. If you win your case, you could win the entire amount that you're seeking. This is something that is just inherent in our business. You can't predict which cases are going to settle. We can't affect which cases settle. But what we know from doing this for a long time and from knowing the way that the litigation business operates in general is this is going to be the result. There are going to be things in all of these 3 components in our portfolio, and it's the blend of those things that generates our returns. And if we could go to the next page, I'll show you what that does for us across our whole portfolio. So this shows you graphically the impact of that. First of all, it shows you the asymmetry in our book. When you lose a case, you're losing the legal fees that you invested around that case. When you win a case, you're winning the damages. You're not going to invest as much in legal fees as your damages are worth. It's not rational to do that. And so when you lose, you tend to lose less than when you win at trial. And so what you see there on the left-hand side are the asymmetrically smaller losses. And on the right-hand side, you see the wins. And now we've got 23 separate investments over time that have generated more than a 200% return on invested capital. And what that really does is it underlines the point that this is a natural part of our model. This is an expected portion of our portfolio. When we have a big win, it's not a one-time surprise. It's an expected part of the way a properly diversified litigation portfolio should perform. And then in the middle, you've got the mediocre performers, fundamentally the settlements. And so let me just flip the slide, but I think we are pretty close to wanting to move to questions. Let me just touch briefly on COVID. So this slide shows a pretty sharp decline in new business in the first half of the year. And there are a couple of reasons for that. These are all COVID related. One is that courts slowed down a lot. In fact, some courts actually closed for several months. The other is that companies were obviously focused on lots and lots of things in their world other than taking on new litigation and getting financing for it. But there's a really important point about COVID for us, which is that lots of businesses lose business forever because of COVID. If you're a restaurant and you've closed tonight or you can't have people sitting inside, you're not going to make that up tomorrow. Whereas in our business, COVID is only causing deferral and delay. It's not causing any actual loss of business. If you have a $100 million claim, you're going to bring that claim. You're not going to just let it slide off to the side. You're going to find a way to bring it. But most claims don't need to be brought rapidly. For lots of COVID-related claims, for example, and we expect to see a meaningful uptick in COVID-related claims over time, most of those claims you probably have 6 years to bring because of the relevant statute of limitations period. If you go back to the financial crisis, we did a fair bit of financial crisis litigation, but we didn't do any in 2009. There's no rush for people to run to court, especially when courts are not functioning all that smoothly at the moment, and start their cases. So it's not surprising to me that we saw this decline in business. The pipeline is rebuilding as things normalize a little bit. But what I do think we're going to see is some years now of increased litigation volume in the system, both because of claims related to COVID and because of claims related to matters coming out of the economic distress that COVID is causing. And I'll just turn the page while we prepare ourselves for questions, and we'll go one more past that with a final point about actually one more past that. And the point that I just simply want to make is around liquidity and the capital structure. So we brought in a lot of cash during the period, and we also generated a lot of receivables that have already started to pay. We often have that dynamic where a case resolves and the cash follows in a while, so it's not unusual for us to have receivables, but nobody gives up their litigation if they're worried about getting paid, so those receivables should turn into cash. And as you can see, so we're sitting on a lot of cash. That also unlocks incremental fund capacity. So we have deliberately created a war chest here in anticipation of some business that we expect in the medium term. And as you can see on the right-hand side, the capital structure of the business is extremely lowly levered now. We're at a 0.14 times net debt to tangible assets ratio. You know, well below the kind of gearing you see in an average specialty finance company with long dated debt maturities. So we're going forward into an area where we think we'll see strong demand for our services, and we're doing that with very robust liquidity and with a strong balance sheet. And with that, I'm going to stop talking so that we have lots of time for questions, and I'll turn it over to Roland.
As you'd expect, a lot of questions here, and they may kind of jump around a bit, different subject areas, and apologies if, again, if I miss your question at home, please do keep sending them in. I'll try and we'll get through as many as we can and pick out the main themes that people are asking. Earlier on, I had a number of questions asking about dividends, dividend policy, and when do you envisage dividends recommencing?
So like just about every other company that I know, during the first half of the year, we took the decision, because nobody really knew what was happening with the economy and with performance. We took the decision not to pay a final dividend for last fiscal year. So the next time the board would take that matter up would be with respect to a dividend for 2020. And the board will discuss that you know, during the annual results process that is in the first part of 2021.
Okay, had a few questions around the US listing. Once that's live, will you be giving quarterly updates?
So the way that we begin our US listing is as what's called a foreign issuer, and so you keep with your home jurisdiction's accounting and reporting frequency. And so starting off, we'll still report just semi-annually, and we'll do so under IFRS. If we get to the point where US shareholders make up more than 50% of our share register, and right now we're somewhere in the low 30s, if we got over 50%, then we would switch to being a non-foreign issuer, and that would cause us to start reporting quarterly and also to start reporting under US GAAP instead of under IFRS, although the two are not dramatically different for our business. And so it's not at all impossible that will happen over the next couple of years. We'll just see what kind of share volumes that we see. I would just, on the subject of the US listing, I would just do one other thing. And I say this, you know, I said this on the earnings call as well, for those of you who are on it. You know, I'm a former tech executive, and I have been, frankly, fairly embarrassed by the plumbing of trying to do a dual market listing. One would have thought that we would be long past some of these issues, but I don't make the rules here. And so, unfortunately, you have to do something. You have to, if you want your shares to continue to be tradable through Crest, which is what most listeners of this session will want, you need to make an election to do that, an affirmative election through your broker. If you don't make that election, then your shares are going to move to the US side of the register, and you may experience some inconvenience for future trading. Again, I apologize for the inconvenience associated with that. I think that we should have a market system that doesn't require this kind of manual intervention, but nobody has yet put me in charge of either of these stock exchanges.
And next up, in the same subject area, will UK investors have the opportunity to see and hear what you're telling potential new US investors about the company?
Sure. So all of our US filings are public on the SEC's website and on our own website. And in fact, what we will end up doing is effectively moving to a world where we use one common filing. And so we may not do it this year, But what I think ultimately you'll start to see, and you see this in other dual listed companies as well, GlaxoSmithKline is a good example of this, where you see the bulky US annual disclosure document. So we would supply that to everybody, regardless of what country you're a shareholder in. And then we'll put on top of that a sort of an annual report style commentary. So I think we'll probably move in that direction. And the US actually has more stringent rules than the UK does about equality of information for investors. And so if I go, for example, and make a presentation at a US investor conference or something like that, the presentations and so on end up on our website.
I had the same question sent in a couple of times by the same person, so I think they're really keen to know the answer. Will the AIM ticker BUR be changing, or will that stay the same as far as you're aware?
No, the ticker remains the same, and in fact, we will trade under the same ticker on both exchanges. So we have the BUR ticker both on AIM and on the New York Stock Exchange.
Thank you. Next up, moving on to Muddy Waters. I understand that Muddy Waters still holds a short position on Burford shares. Given the impact of their last foray, what measures are you deploying to counter their activities?
I am not aware that Muddy Waters holds a short position on Burford, and there isn't one disclosed by that firm. And from my perspective, Muddy Waters is ancient history. I think we thoroughly debunked the noise that Muddy Waters came out with a year ago. Look, the reality of this is that if any of the allegations being made had truth to them, the very last thing that any intelligent person would do would be to go and voluntarily go through the SEC and list in the States. I'm subject, for example, to personal criminal liability under SEC standards for listing the business there. So, and I'm a lawyer, so I hope people will give me a little bit of credit for forethought and planning. And so if you're doing something dodgy, the very last thing in the world you do, you'd have to be dumb as a post to go and voluntarily take on a US listing.
Okay, next. Does Burford seek to insure against their losses and the consequent liability to meet the other side's costs, I guess, in those situations where you might lose a case?
No, but let me expand on the adverse costs point a little bit. So on the substance, we certainly do not insure our own capital. It would be expensive to do so, and we would basically be turning our business profits over to an insurance company. Our stock in trade is basically doing what an insurer would do, which is underwriting litigation, and frankly, we're probably better at it. And so we have a very low loss rate, and we generate our returns because of the risk that we take. So we don't pursue insurance for our own portfolio. On the subject of adverse costs, first of all, adverse costs are not a factor in most American litigation. And indeed in a number of other countries. So this is a minority of cases. But we seek to make sure that adverse costs are provided for in some way in our cases, either by the client itself taking on the adverse cost risk, or by buying insurance against that risk. And we in fact do offer that insurance. We own an insurance company. It's called Burford Worldwide Insurance Limited, that does write adverse cost insurance for clients when they need it, and we turn around and reinsure the significant majority of the exposure that comes from those insurance policies.
Next up, have you seen any funding inquiries that relate to cases connected with COVID-19 issues, for example, breach of contract?
Yes, yes is the short answer. What you're going to see in COVID litigation directly is you're going to see cases, number one, that are outside the world of insurance, that do, as you just said, relate to things like breach of contract. So you're going to see lots of litigation there, and you're also going to see lots of insurance coverage litigation, where a policyholder is disputing with an insurer whether there is coverage for their loss. And COVID has, unlike something like the global financial crisis, where there was some amount of litigation, but a lot of people, even though they may have lost money, didn't have any legal recourse. With COVID, the questions are unanswered really across industries and across the world. They're going to depend on individual legal systems. They're going to depend on the language of contracts. And even the most basic commercial undertakings are going to give rise to disputes. You know, you're a banana company, and you ship a shipload of bananas to your customer, and they can't get unloaded in time because the port is closed because of COVID. You know, you've got a bunch of legal questions there. Who bears the loss, the shipper or the receiver? Is the insurance that attached to that shipment going to pay in the light of a pandemic? So what seems like a pretty elemental commercial transaction just there gives rise to several different questions that are not yet answered with any great clarity. What you also do see though in the market, and so for example, there are already more than 4,000 reported COVID cases running in the US. The other thing though, and I made this point earlier, you don't have to rush with these cases. Most businesses don't have any desire to be the first mover and to spend basically the extra money figuring things out. So you're going to see a lot of people wait and watch to see what happens, and then you're going to see a lot of claims once there is some greater clarity initially from the courts.
Okay, can you discuss your framework for risk-adjusted return targets when bidding on a litigation? Has there been any pricing pressures? Can you quantify the change over the last 5 years?
So the way that we approach pricing litigation matters is as the question suggested, on a risk-adjusted basis. And there's a wide variety of pricing based on perceived risk in these matters. We would price, for example, a high-risk intellectual property case that is just starting trial. I'm sorry, just starting the case, hasn't gone anywhere near trial. We would price that very, very differently with much more expensive capital than the case that has already won a trial and is going up on appeal. And we will involve ourselves in cases at any stage of their life, including, we involve ourselves in cases even after they've gone all the way through the litigation process and won, and the issue at hand is collecting the judgment as opposed to actually litigating the case. So we do it all across that gamut. And the pricing is absolutely based on our perception of risk. And we do extensive modeling using proprietary data that we've built up over the last 11 years to come to what we believe are appropriate levels of risk and return for us. Are we seeing pricing pressure in the market? This market has always been competitive, and clients always want to pay less for capital. That's true in this market, and it's true of any financial services and any capital market that I know of. That being said, the reason that we're able to generate the returns that we do is because we take on that binary risk of loss. And I think that there is a general understanding, both among clients and among market participants, that capital is going to be expensive when you run the risk of losing all of it when the case doesn't perform. And so I continue to think that desirable returns are available in the market. And I think it's a point to underline there is that the returns that we generated in the first half, which were high and actually made our cumulative returns go up a little bit, those returns are all from business that we wrote, or mostly wrote in the last 4 years. So it's not as though the early days were the golden days and now we're in a different world.
Could we have a brief update on the Peterson case and when that will be resolved?
So the Peterson case really is two cases within one. The first half of the Peterson case is the question of whether Argentina and YPF can be sued in a US court, what's called a jurisdictional question. And that was litigated very fiercely. It took several years. It went all the way to the US Supreme Court, and we won that portion of the case, which was one of the significant risks in the case. So having won that, the case now has returned to the trial court as of last year as a regular contract case. And it's going through the usual US litigation process. That process is unfolding. The trial judge has set a schedule for the case that's publicly available. It calls for trial at the in the middle of next year, next summer. You have to take that with a little bit of a grain of salt. The reality of American trial schedules is that they certainly can slip, but at the same time, the pace that the case is on suggests that the court is interested in having it move quickly rather than slowly.
Next question. With regard to corporate clients, I'm looking here at kind of Fortune 100 companies, how does Burford win the relationship? Is this one through relationships you already have, I guess, a business development role, or through competitive pricing? If not through pricing, what does Burford offer that competitors don't or can't replicate?
So we win relationships through really all of those means. Sometimes we win them from direct business origination, and we have a full-time origination team that just goes out and talks to clients about potential new business. We win new business from referrals from law firms. We have strong relationships with a large number of the world's major law firms. And frankly, we win business because of our brand in the marketplace, our scale, and the reputation that we have. You know, the number is, I don't think, in these slides, but a very high percentage, when we do market research, a very high percentage of lawyers identify Burford either first or only as the brand they associate with litigation finance. And so we're starting from that leg up. And some of the other things that we do, you know, they're certainly good for shareholders, but they also are good for the underlying business. And a New York Stock Exchange listing is an example of that. That just adds credibility. It buttresses the reputation that we've already got in the marketplace. And so if you were a CFO of a Fortune 100 company, this is not commodity capital. You need a financing partner that knows what they're doing, that has the scale and the expertise to be able to deal with your complex litigation needs. And we think that we're a pretty obvious choice for those clients.
Does or do you see continued growth being mainly organic, or would there be scope for acquisition in the future?
Well, we're not, as you know, a serial acquirer of businesses. Burford has made 3 acquisitions in 11 years, 2 of them quite small. One was our insurance business in 2011. One was our asset recovery business in around 2014 or 2015, and one was our fund management business in 2016. We haven't done an acquisition since then. I certainly don't foreclose non-organic expansion, but I also, I don't think that you're going to see us transform ourselves into a business that really fundamentally grows by acquisition.
And so those acquisitions were to add services to the portfolio rather than kind of buying clients or buying a direct competitor, I guess. Then I've got a lot of things here to try and pick out the next one. Have you seen any additional slowdown in the progression of cases due to the second wave of COVID-19 in countries that you operate in, or are the legal systems there largely still operating relatively smoothly?
You know, it's not even on a country by country basis, it's on a very local basis. Different courts are dealing with COVID differently. Some courts have more easily moved to video-based and remote activity. Arbitrations are easier than courts by and large, because you don't have the same dynamic of trying to have public presence. I think it's fair to say that jury trials are not still going on anywhere. I don't know of any jurisdiction that is successfully having jury trials right now. Bench trials have resumed by video in some jurisdictions, but not all. But the other issue is not just court function, but it's also function of the actual litigation process. So, you know, even before you get to court, there's a lot that happens. The lawyers have to get access to and review and produce a lot of documents. There are pretrial depositions of witnesses. And so at sort of at every stage, while those things are continuing, they are certainly being impacted by COVID in some instances. The second wave dynamic, from my perspective, was more that it stood in the way of things returning to normal, as opposed to it pushing things back. Not much happens in the summer often in litigation, and so you had a pretty chaotic spring. Things were sort of coming back in June. Then you had the summer slowdown, and then the second wave was sort of upon us before things really tried to reopen in the fall.
Okay. Question here about cash conversion of booked profits from inception, and there's been some of the I guess criticism that was leveled was around booking profits prematurely. So what approximately is the cash conversion of booked profits from inception? Can you answer that?
If I understand the question right, it's total. So the way the process works, and first of all, bear in mind that we provide cash on cash numbers in addition to the audited financial statements. So you can go on our website and you can download a detailed table that shows you every single investment we've ever made, including the ones that are ongoing right now, and shows you the cash position as to each one of them. There's no profit booking, there's no accounting valuations in those numbers, and that's candidly the way in which we run the business. I don't spend a lot of time managing to the P&L because I can't spend cash that I don't have. That being said, we live in a world of accounting, and we're required to value our assets just like anybody else. And so we have a high degree of I think what the question is getting at is we have a high degree of correlation between the valuation changes that occur during the life of an investment and the ultimate outcome. And there is, on our website, there's an extensive analysis of fair value, and it's also in our most recent annual report, where you can see how those valuations have performed against reality. But the bottom line is that it's unusual for us to see completely different outcomes than the valuations project. And if you set aside the YPF-related assets, the valuation portion of our balance sheet is relatively small.
Okay, I hope that if that was your question at home, I hope that I expressed correctly what you were trying to ask there. Has there been any research on the total size of market, and then how much of that are you going for, and then how much of that do you currently have?
So the size of the market is the size of the addressable market for Burford is still, I think, imponderable. We know a lot about the size of the legal market, and it's enormous. More than $800 billion a year in legal fees, probably $1 trillion or $2 trillion in awards and recoveries. Just as one random data point, I think it's the leading 30 arbitration firms, don't quote me on that, but it's on our website. Though the firms that do the most arbitration in the world collectively have arbitration claims that they are currently litigating that are in excess of $2 trillion. So the legal market is vast. Not all of that is addressable to us, and never will be. There will always be legal activity that happens outside the realm of financing. But we've certainly seen material growth over the past, and the market research that we've done and published, and by the way, another set of that market research is coming out next week, suggests that there is continued strong demand for capital growth here, and that people expect that to continue on.
And further to that, looking at other markets, different jurisdictions, do you have any activity in China, Japan, Middle East? Would you have any interest in kind of expanding out to those places, if not?
So we operate around the world, but we don't operate locally in some of those markets. And litigation is to some extent an export business. So we take clients of the large law firms sort of anywhere in the world that we find them, but the bulk of the work, the bulk of the dispute activity occurs in, a number of known courts. For example, the English courts get many more cases than relate to England. It's not at all uncommon for foreign actors that have nothing to do with England to be litigating in the English courts, because the English courts are perceived as being neutral and impartial, and their judgments are respected. And so you could easily, well, there are famous cases where Russian oligarchs favor litigating in London than litigating in Russia. So we wouldn't do domestic Russian or domestic Chinese litigation. But we certainly might have an Asian client or a Middle Eastern client where we do work for them in other jurisdictions.
Okay. I think on that note, we are on time, Christopher. So thank you very much for taking all of those questions. There's a few more around the question of dividends again on the US listing, but I think we've got through most of the key things that people wanted to know about. So thank you for sending those questions in, and thank you, Christopher, again for answering them and for joining us this evening.
Well, thank you all for having me, and I appreciate the extra time so that we were able to get through a lot of those questions, and we'll look forward to talking with you again soon, hopefully one of these times in person.